AI is the greatest invention of mankind since fire, since we invented fire about 50,000 years ago. Nothing comes close. Nothing will ever come close because AI is the uber invention. AI is the invention that creates all other inventions.
The military taught us discipline, it taught us leadership, but it never taught us how to really build wealth and income. This is the Active Duty Passive Income Podcast, and I'm your host, Markian Sich, a United States Marine turned full-time real estate investor and educator. I'm bringing you the most successful military, veteran, and military spouse real estate investors, entrepreneurs, and industry experts to break down exactly how they did it, so you can too. Hey there, ADPI. It's Markian Sich again. And gosh, I'm recording 2 podcast episodes this week, and these are back-to-back just juicy ones. We have somebody on today that I learned about, heard about since my very first days of getting into multifamily. And it's just really cool to have this individual on here. And I think, which for all those that are a little bit nerdier, are really going to enjoy this conversation. We're going to deep dive into some multifamily stuff. We're going to talk about AI. We're going to talk about what's going on big picture in the world and in investing. So without further ado, I'd love to just introduce and welcome aboard here Neil Bawa, who is the CEO of Grocapitus, right? Did I say that right?
You did.
And a real estate a real estate futurist, an AI and data center expert. The data center part there is going to be very interesting. But let me just say, if you guys are just starting out in real estate, don't let this conversation scare you, okay? This is important stuff, and it'll give you context that you probably didn't even realize you needed. So, Neil, thank you so much for coming on board. How are you feeling today?
Great. Thanks for having me on the show. It's fun to be here.
Yeah, absolutely. Yeah. So I would love to just first give as much maybe background and context as possible, because it's going to help everybody piece together like what our conversation that we're about to have. But like, who is Neil Bawa before the Neil Bawa that a lot of people know right now? Like, where did you come from? What's your background? What's your story?
Well, I am a technologist, so a reformed technologist, data scientist, computer science degree, ran a big tech company from 1997 to 2013. And while
Okay.
I was running the company, I was living in California, big fat tech salaries. I was paying 50% of my income as taxes and got into real estate just for the, selfish purpose of paying less in taxes and doing it legally. Invested in real estate by myself, no investors, for about 10 years. And during that time, for my technology company, built or partially built 6 campuses, and I used the depreciation for those to massively reduce, increase my take-home income, reduce my taxation, which meant that by the time I had millions of dollars saved in banks, it was 2008. And so my timing was incredibly fantastic at that point in time. It was a great time to buy. I couldn't convince anybody
Right.
else of that, because if you said in 2008 in a party that this was the greatest time in 100 years to buy real estate, people would laugh at you or think that you had gone
Oh my
crazy and
goodness.
start referring you to a psychologist. I unfortunately didn't listen to them. I did say that. I said it to a bunch of people. My own family disowned me. And so I went out and said it in a meetup group to a bunch of people who didn't disown me. So we ended up buying dozens and dozens and dozens of single family homes that I still own. They've all, gone up 5x from what we paid for them during that time.
Sure.
And so it was very fun. And so I became focused and obsessed with publishing real estate data science because, my family members are very smart, very rich, right? They have a huge empire, a food services empire. They win national awards. But they didn't listen to me because they were not data driven. These are gut feeling driven, hardworking, smart, experienced business people. And what I realized was
Okay.
there are lots and lots of very, very smart people out there that don't understand real estate data science. So I have made it my career and my mission to publish real estate data science, and about 50,000 people now follow our data science.
Wow. Wonderful. Okay. Let's, you mentioned 2008 just briefly. When I got into real estate was when I really kind of caught the bug was probably, it wasn't so long ago, to be honest. It was like 2016, 2017 is when I started acquiring my first properties. and for those who have been listening to the podcast, that like I actually bought a 56 unit apartment complex before even buying my first primary residence. But what I wasn't so sure about is like a lot of the data you're talking about. Like I just needed to take a step, and I just knew I needed to take action. But the one thing that was always so scary, the thing that probably caused the most analysis paralysis was what you're talking about, like 2008. Like I remember learning, it was like, I'm never gonna have a floating rate loan or any of that kind of stuff. And lo and behold, I still fell into that trap a little bit with an SBA loan, but that's a story for another day. But yeah, so you saw the ups and the downs, and you rode from the bottom to the top essentially from 2008 onward. And now what you're saying is, now that you saw the full from A to Z, you're saying that there's indications and patterns happening, and you kind of think what's happening next. Is that right?
I try. So my crystal ball is just as defective as everyone else's, but there is
Yeah,
one
right.
area in which my crystal ball is 100% or close to 100% accurate. So we can talk about that one special crystal ball area and how I'm able to predict something that is going to happen in the next 24 months in the US. But for the most part, what I like to do is to use patterns to improve my hit rate. That way I can be
Right.
wrong, but if I am less wrong than 100 other real estate investors, I still have better outcomes. And if you think about it, there's just like everybody knows the S&P 500, right, makes, about 6% a year. That's sort of a 100-year number of what the S&P 500 makes. And then there's an equivalent number for real estate that very few people know. It's called the NCREIF, NCREIF. The NCREIF is a way of measuring how much do real estate investors make in commercial single family. And it's about 9%,
Okay.
right? So people who don't have access to any of my data are making 50% more than they would make in the stock market. That's pretty awesome. But there's many of them that are losing money, because in real estate, many people lose money just like they do in
It's an
stocks.
average. Yeah.
And so my goal
Sure.
was, how do I use data to make quite a bit more than 9? Can I get to 15? Can I get to 18? Can I get to 20? Even so, when I'm wrong on an aggregate basis amongst 35 or 40 projects, I'm involved in about 40 different projects, about 6,000 units. On an aggregate basis, my track record would still be a lot higher than 9, and it is. I'm in the high 20s, and I've had projects that have failed. I've had projects that didn't make the money that they were supposed to make. So the data doesn't basically make me bulletproof in any way at all. What it does do is improves my hit rate very substantially. And so that, along with the one working crystal ball in that one, area, gives me a significant advantage over most people. And the thing that we're most known for, right? So we have, 14,000 people a year that sign up for our webinars. And the number one thing that they want to know is, what are the cities to invest in the next, 12 to 24 months before those cities become known to everybody else? And so in 2008, I got obsessed by that one question, because I would go and talk with somebody and I would say, Markian, what should I be investing in? And they would say something like, well, I've heard so-and-so city is great, right? Provo, Utah is great, or, Minnesota is great. And I'd be like, based on what? They'd be like, well, I've heard it from this guy and he's really smart. And so you'd basically hear that over and over again, that they had heard from somebody really smart that this is a great place to invest in. And my experience was, there's a lot of very, very smart people that don't know anything about real estate. That doesn't make them any less smart, but that doesn't mean that they're good for predicting real estate trends. And so I was like, I'm not getting a straight answer from anybody, and I'm a data scientist. So why don't I basically gather data on...
Hey guys, Markian Sich here. Really quick, before we roll into the rest of the episode, I want you guys to know that you now have an exclusive opportunity to buy a military real estate investing conference ticket at half off and get put into a drawing to win a VIP upgrade. All you have to do is go to activedutypassiveincome.com/conference and then use the coupon code POD50, POD50, and you'll get 50% off, and you'll be put into a drawing to win a VIP upgrade if you're one of the first 10 to buy it. Do not delay. It's coming up October 10th through the 12th. So if you're listening to this podcast and it's not October 10th, 2025, you're in luck. You still have a chance to get this 50% off and win a VIP upgrade. It's going to be an incredible conference. It's all going to be about focusing on how to make it cash flow. You know, everybody asks, like, how will it cash flow? Well, we're going to focus on how do you make it cash flow? Despite everything that's going on in the market, all the creative ways, house hacking 2.0, ADUs, co-living, rent by the room, creative financing, sub 2, all that kind of stuff. We're going to have real stories on stage telling their real successes so that you guys can learn all the very tactical ways of doing this. So anyways, onward and upward. Good luck with your real estate investing, and I'll see you in San Antonio on the Riverwalk at the beautiful Westin for this year's conference. Again, activedutypassiveincome.com/conference with the coupon code POD50. See ya.
Lots and lots of different markets. So the next inevitable question was, how many markets are there in the United States? Well, the answer is 322 MSAs. How many cities are there in the United States?
I'm going to write that down.
Sure. And actually, you can go to Wikipedia, or you can ask ChatGPT to give you a list of all MSAs in the US. These days, I spend an hour every day talking to ChatGPT, but in the past, you know, the list that I got was from Wikipedia. There's 1,016 cities, or what qualifies as cities or towns in the US. And so that was like, okay, so if I want to rank, 323 metros or 1,000 cities, how would I go about doing that, right? So back then, no ChatGPT. Now you can actually ask this question and it'll give you a really good answer. So I thought, okay, well, let me go back, read some books. And I read some books, and basically one group is saying, well, demographic data, right? Which is population growth, job growth, income growth, home price growth, crime, schools. And then you've got the supply data, how many units are coming into a certain market? Is it going to get over flooded? Is there, is the supply significantly lower than demand or significantly higher than demand? Those are the two areas. So I said, okay, where do I get this information? Well, back in 2008 and 9, I was mining websites. So the demographic data that we use comes from a website called BLS.gov. The Bureau of Labor Statistics, BLS.gov, is a free website. It is an extremely unfriendly website, right? So just like any other government website, they're not trying to do insights. They're trying to basically put terabytes of data on these kinds of cities. So we had to basically go and write scripts to, grab data and then massage it and clean it up and, and put it into statistical analysis software. Again, much easier to do with ChatGPT these days, but we didn't have access to that. So we'd clean the data up and put it there. And now we had a way of comparing cities for population growth, job growth, income growth, home price growth, right?
Apples to apples.
Apples to apples, which cities are the best, right? Because people would come and say, this city is fast growing. And I would say, how do you measure that? And they wouldn't have an answer. So now I had an answer to say, Provo, Utah is growing at 2.6% a year, whereas Kansas City is growing at 1.5%. And this city that you've just told me is amazing for investment, Dayton, Ohio, it just lost 26,000 people in the last 5 years, right? So I had a benchmark, a way of actually objectively thinking about things. And so I continued to expand on that. I continued to add factors and methodology. Then somebody said, you should do a meetup group about this. So in 2009, inside my technology business, I had huge conference rooms. I said, the San Francisco Bay Area has horrible traffic. So I was like, I'm not going to go, after 10 hours, 11 hours of running my company, fight another hour and a half of traffic. So how about I do this? I have this conference room with 100 seats. How about I open a meetup? Call it the Real Estate Data Science Meetup. First time I did it, 4 people showed up, all data scientists from Apple and Google and LinkedIn, because, I'm in Silicon Valley.
That's so cool.
And then the next time I do it, 10 people show up. And the third time I did it, 100 people showed up. We had standing only room, right? Because I was in the nerdiest part of the United States. There's so many data scientists here, right? That people
so many nerds.
people were really listening. And this audience was more flexible in their viewpoint, because when I showed them the data and I basically made the prediction, I said, this is the single greatest time to ever buy real estate in US history. This is 2009. And most people would laugh me out of the room, but the data scientists would say something like, show me, prove it to me. So we'd start going through the data,
numbers, and
we'd start looking at the data and start looking at trend lines, and they'd be like, oh my God, you can't lose any money, can you? No, I can buy a single family home that costs $270,000 to build for 90 grand. And the moment I buy it, I immediately get $1,000 a month in rent. And my mortgage is only $70,000 a year, and the interest rates are 4%. How possibly could I lose money? What possible scenario could there be in which I lose money? So we would go through those kinds of analysis, and we do them for different kinds of cities. And the audience was much more easy to convince because they were, numbers guys.
Sure.
And so we formed this meetup, and then another guy comes to me and says, let's turn this into a toolkit. And because at that point we were basically like on screen doing actual code, writing code of output from our statistical analysis software. Remember, I was taking all this data from BLS.gov and Zillow and Trulia and all these kinds and sticking them into a software. And we would query the software. And that software query is called SQL, Structured Query Language. And so we would write a SQL query and we would look at the response, and people would be like, this is only for geeks. How do you get 1 million people to understand this? So we said we should create a toolkit, and the toolkit should be transparent, meaning what you do is you write all your structured query stuff, all your code stuff, and then whatever insights you come up with, you turn those insights into plain English language. And then you give it to people and say, do this, right? And so we were able to do that. And so, for example, we were able to basically say something as simple as this. If a city is over 250,000 people, then you only want to invest in cities where the population growth of the city over the last 5 years is 1.6% a year. Now, when you go below 1.6%, it doesn't mean you won't make money in real estate. You'll just make less, right?
Yeah.
And we were able to say something like, you only want to invest in cities that have 2.1% job growth per year, because above 2.1% job growth, everyone in the area floods the market with money. So home prices, instead of going up 4% a year, go up 8% a year or 12% a year. We were able to find tipping points. You know how it is. You get growth, and then you get straight line growth. Where's the tipping point? We were able to find the tipping point for population growth, job growth, income growth, home price growth, crime reduction, school quality. There was a tipping point beyond which you get on the steep curve of the hockey puck. And that's where you want to be, right? And so we were able to start predicting disproportionate returns. And how close is a city to disproportionate returns? And we were able to turn that into a toolkit. We called it Location Magic. And somebody suggested we create a course on the web. And so we created a course on a website called udemy.com. There's millions of people taking courses. And I thought maybe 100 people a year will take this course. If you type in the word udemy.com space Neil Bawa, right? Just my name, or udemy.com space real focus, one word. Right now, I think there's 14,000 people taking the course, right? And it changes. Obviously, the number is higher at the beginning of the year. So, Udemy space real focus or Udemy space Neil Bawa, you'll find the course, right? On the Udemy website. So right now, if I click on it, I'm going to click on it right now.
Yeah.
I have 14,004 people taking it right now, right? So that number changes. And you can see it's the most highly ranked real estate course on all of Udemy. There's about 1,000 Udemy courses on real estate, but this is the highest ranked. And pretty much everybody gives it 5 stars because there's no pitch. There's no next step. At no point in the course do I say something like, I have an educational program to make you a genius. My pitch is, everything that you need to know is in this course. You don't need anything else, and you never need to talk to me again. So everybody gives it a 5 star.
Yeah, you're basically targeting, you created an antidote to a pain point. Somebody has a specific need. You created them the nut and bolt offer, and you're like, here is the solution. It's self-contained. This is all you need. And you did that on the largest basically online university platform out there, and it caught on. As an online, it's funny, I don't even refer to us as an online education company community, because so much is online. It's almost, no, we are an education community. But anyway, I digress. But yeah, no, that is very inspiring. That's fascinating. And how did you, when did the step into the larger commercial multifamily stuff happen in your timeline?
So all of that stuff happened before I had a product to sell or a service to sell, right? So I don't provide an educational product today. You can't basically buy education from me. I'm not interested in selling those kinds of things to you. In 2013, we received a much larger offer for our tech company than we thought it was worth. So it was one of those people that, we thought these people are stupid. Turned out they were actually very smart. And they made us an offer. And the amount of taxes that I would have to pay in 2014 were gigantic, right? So I would have to pay 39.6%, federal, 39.6% federal, 13.3% California, and 2.6% Obamacare. So 55% of the money that I was making from selling the company would
That's like
basically
France.
Yeah, it's nuts, right? It's completely nuts. Remember, I'm in the highest tax category federally, and then I'm in the state that has the highest state category, and then the Obamacare taxes had come in the year before. So I'm like, how do I get away from this? And so, I go talk to my friends. I have this amazing meetup community, and they say, you already know how to do this. I mean, real estate. I'm like, you realize how many homes I would have to buy. This is an impossible task to do in 5 months because I had 5 months left in the year. And so somebody else says, you've been talking about multifamily all these years, but you haven't really jumped. I mean, I had at that point bought a 14-unit property, but my problem was much larger, right? I'm talking about 1,000 units now, right? So I'm like, okay, I have a really serious problem, and I have 5 months to fix it. So I call a meetup, I promote the heck out of it, and I basically talk with people and say, who knows multifamily? A whole bunch of people show up at the meetup. I sit down with them around a table and say, we need to buy 1,000 units, and I can't fund all of it. So you guys basically bring in your properties, we'll underwrite them, we'll do this kind of stuff. And I can fund most of it, but not all of it. So we're going to have to do something known as a syndication. And so they're like, yeah, but we don't have this a community of people that'll give us such a huge amount of money. And I'm like, no, we have to buy 1,000 units because otherwise I'm going to pay millions in taxes. And so what we did was, I had this community that I'd built on Udemy and everybody else for years and years and years, meetup group, thousands of people, but I never asked them for anything, right? Because it was an educational community. So I went back to those people and I said, we're going to buy these buildings. Here's what the profit, numbers are. We'd like you guys to join us as investors. So we were learning about this thing called syndication. And so our goal was that if I could get it so that 50% of all the money came from me and 50% came from the investors, then I'd almost be able to get my taxes down to zero. As it happens, those people were so ready from 5 years of getting stuff from me but never being asked that we sold the syndication out in 4.5 hours. 4.5 hours.
What was the total raise?
32 million.
Holy macaroni. I mean, that must be the highest dollar per hour volume I've ever heard. I mean, do you know of a real estate syndication?
We've surpassed it since then because we take $100 million checks all the time. But my point is, at that point, I was just stunned with what was possible, right? Because I didn't know if this database that I had was worth even a single dollar because I'd never pitched anything. I've never sold anything, and I never sold a list to anybody else. So I looked at that. Obviously, it resolved my really desperate problem of taxes. But I think I looked at it and I said, if this database is worth $32 million once, maybe it's worth something again. So I tried again for the following year and it sold out again. And so I said, I think I should look at this as a potential career. So it took me about 2 years. I had a golden parachute, so I couldn't really leave my tech company. I was not allowed to leave. They keep some of your profits in there for like 18 to 24 months and you have to train your replacement as CEO.
Is that what you call as an earnout? It's an earnout,
right? So it's a tech companies use an earnout. So I had an 18-month time frame, and as it happens, the buyers of your tech company, they tell you hire new people, you build systems and processes, but then you don't do their job because we need to get you out and we need to get these people in. And so as those 18 months went by, I only had 2 or 3 hours of work every day. So I had plenty of time to transition into becoming a full-time syndicator and do it while still earning a $400,000 salary.
That sounds pretty good.
I think it was a good deal. And they were okay with it. You know what's funny is the buyers of the company were a group called Cressy. They're based in Chicago. So we would go to Chicago once a quarter to present to them. And
Cressy was the buyer?
Cressy. The C-R-E-S-S-E-Y. There's a senator.
Okay, never mind.
So we would actually finish our presentation, which was about the tech company and our revenue and stuff like that. And then they knew that I was buying stuff. So we would all pile into a van and go off to do real estate. And so I got those people into real estate through me. And so it was all all done above board. They knew I was doing it. And they were like, yeah, but you can't put work in because the people that you're training need to do the work, not you. So it was very cool, actually.
Wow. That is remarkable. And okay, your story's fascinating, but now I'm going to try to transition a little bit into the actual, let's talk about today, right? Let's talk about what's going on with multifamily. let's talk about AI, let's talk about data centers, all this kind of stuff. I immediately started like my nerd brain started like getting really excited when you were saying all that kind of stuff. Like I remember still having to learn MySQL. Like I was a computer science guy at the Naval Academy when I was graduating. Never got to do any of it or put it to use because I went flying antiquated aircraft instead. But what I found is that just having that background helped me in so many ways to just be more confident and comfortable with technology, period. It's almost like I was able to pick things up. Like when AI came online, I was just like, where has this been all my life? You know what I mean? And it's funny because like my dad, who's a physics and calculus professor, it's like I saw the whole, oh, you shouldn't be using the TI 200 calculator happen all over again. It's like, well, you shouldn't be using, AI too much because it's going to help you too much. And I'm like, well, how is like,
Not
as
at
a
all.
human, like, we all have to level up to use the tool so we can accelerate faster at some point. But I digress. It's just really cool listening to your story. So a couple of things that stood out to me, because I read some of the things you wrote to us, and it's the new, or actually I'm going to stay on real estate for just a little bit longer before we get really nerdy. It's the air pocket. So you're saying that like you believe multifamily is in sort of a air pocket right now. What do you mean by that? And how should, a smart investor prepare for this phase?
So first understand this, that there's never any real opportunity without some negative news. And there has to be actually plenty of negative news for there to be real opportunity. So if I was to look at multifamily today, right? And it's fair to say that there's been plenty of negative news about commercial real estate in the last 24 months. Would you agree with that? Right?
Yep.
Okay.
100%.
Now, I want you to ask the second question. If you compare the amount of negative news that we've seen about multifamily today compared to what happened to single family in 2009, which one do you think was much worse?
The single family in 2009?
There you go.
Or no?
Absolutely.
Yeah. Okay.
And I'll tell you why.
I'm like passing a test
I'll
here.
tell you why.
Yeah.
So single family values declined in the 2008 crash by 29% nationally, but certain markets declined by 70%. For example, I bought dozens of homes in Madera, California, and that declined by 69%. So,
Holy mackerel.
right, $250,000 homes were now being sold in Madera, California for $90,000. I bought 12 of them. So same thing with Phoenix. Phoenix was down about 50%. Parts of Florida were down 55%, but nationwide it was 29%. We have not seen multifamily decline by 29% in this decline. We actually haven't even seen office, which is hit much harder than multifamily because its vacancy levels have gone through the roof. They haven't declined by 29%. They're almost there. They're like 26, 27% decline. But here's the big difference. Imagine late 2009. There are brokers where you can walk into their office and say, I have $10 million. Can you please send me 100 homes at $100,000 each? And within a few hours, they would have 100 homes to sell you. There were 5.3 million unsold homes in the United States, right? And look at where they went after that crash finished. Those homes are now worth about 2x, 2.5x what they were worth back then. Now, try this on for multifamily. So today with multifamily, prices have declined by about 20%, right? And I have this context, we currently are involved in about $800 million of multifamily, about, 5,000-6,000 units. And the context here is this, that in the last 12 months, we have not been able to win a single multifamily offer. So contrast that with walk into a broker's office, say, I want to buy 100 of these units at $100,000 each, and have a list prepared for you in an hour, where they would even come back to you and say, would you like to buy 1,000, right? Today, we have made 33 offers on multifamily properties in the last 12 months. We have lost 33, right?
Wow.
Why?
That is a clue.
Yeah,
that is a clue.
So there is no distress in the multifamily market as such, because when you make 33 offers and you lose 33 offers and you only get into 3 best and finals, that means that the demand is extraordinarily high, right? What is there is a price reduction. So today, multifamily prices are about 20% lower than the Q1 2022 peak. So they've gone down by 20%. So they're lower by 20%. And this creates distress in certain properties. Certain properties, their investors have lost all of their money or they're at risk of losing all of their money. There are properties where the bank loan is higher than the value of the property. Those are all small definitions of distress for those banks, those investors. But are they a definition of the industry in distress? Not at all. Show me a single market, small or large, out of the 1,016 in the United States, where properties are being sold on courthouse steps, or somebody lists a property through CBRE or Marcus and Millichap, some reasonable broker, and not a single offer comes in. One market in the US, please show me that. Now, there may be one property somewhere, which is a ghetto property, but there isn't a single market out of 1,016 cities in the US where a multifamily property is properly advertised and doesn't immediately get 3, 4, 5 offers. May not be the price that the seller is looking for, but the hunger, the desire, the demand
People
is
want
there.
Yeah.
So understand the massive difference between this decline and 2008.
Yeah, boy, that really resonates with me because like I basically took a pause, partially because I know I haven't told you a little bit about my background that much, but I essentially am focused on two different asset classes now. It's basically C plus multifamily and memory care. Okay, so my mom's very passionate about caring for the elderly. She cares for her parents. She cared for my grandma before she passed away, and so she really wanted to help with dementia and Alzheimer's. So we do that north of Atlanta, and but what I've saw I kind of like pivoted just a little bit because I wanted to do kind of like a family passion project. But what I did see is after we sold properties, like I mean we went full cycle on a syndication in under 2 years, doubling our investors' money. Like we thought we were like the smartest people in the world. But then I realized, okay, now on the flip side, how the heck am I supposed to buy these things when that's what people are paying for? So I basically took a pause, and now I'm finally under contract again on a 72 unit that I'm getting at a price that I'm like, no, this makes sense. Like it's like I had to fight for it, and that's a whole other story. But like, it makes like if you have a good team and the seller can have confidence that you're actually going to close, and you can get under contract. Like now, I do 100% believe what you're saying. Now is a good time. And so when you're talking about that air pocket, are you saying that it's basically just the price drops on some of these assets are a smokescreen to the actual potential that the industry has? Is that what you're saying, kind of as a pocket?
Yes, but I'd like to qualify that, right? So
Okay.
prices have dropped by 20%, even though there hasn't been any real drop in the industry's income. So let's look at 100,000 large multifamily properties together and say, what is the income of these properties today, right? And income basically means you take rents and you take your expenses and you subtract
Revenue,
the two, right? So it's before lending, because lending goes up and down and every property is different and you can always refinance, right? So you're simply looking at all of your property expenses and all of your rents and other income, and you're subtracting it. This is in the industry, this is called NOI or net operating income, but it's basically income before your mortgage. There's been no change at all in the last 2.5 years. Now, it hasn't gone up. Now, you might say, why hasn't it gone up? Firstly, as in 2022, you could get a 4% or even 3% construction loan, right? I got one for 4%. Most people got 4 or 5%. So the industry got flooded with new apartment complexes and new townhomes. And those townhomes and apartment complexes started delivering in 2024 and are delivering again in 2025. So there's 2 years of extraordinary delivery for a supply glut of Class A apartments in the United States. The first year of the supply glut was 24, the second year was 25, and there was a little bit in 23 as well. And because of this supply glut, if you look at good markets in the US, rents are down 1 to 2%. If you look at it overall in the US, the rents are maybe up 1% since then. And you might say, okay, so why hasn't the income increased by 1%? That's because of insurance cost increases. So insurance across the US has been increasing very fast. And so because of that, we've had basically no change in the industry's net operating income. So if you take the whole industry, our income is the same, but our price is 20% lower, right? And you might say, why is it 20% lower? Well, because mortgages are higher, right? So, you pay a lower price when your mortgage is higher because once you have net operating income, you still have to pay your mortgage. Now, am I saying that mortgage component is going to change? I'm not. I'm not saying that interest rates are going to be cut radically. We might see 2 rate cuts this year. We might see 1 next year. I don't think that fixes the problem. I don't think that's the opportunity. I think it'll happen, but it'll happen at a very slow pace. We've got tariffs and all kinds of other issues. The real opportunity is that today, whoever is buying today is buying based on depressed rents and higher cap rates. Remember, higher cap rates means lower prices. So cap rates in the United States have gone up, for those who understand them, by 110 basis points. Right? So if Phoenix was at 4, 4 cap, now it's 5.1 cap, right? If Kansas City was 5.5 cap, today it's 6.6 cap. So they've gone up about 110 basis. And some cities have gone up a little more than that. Some have gone up a little less, but 110 is the industry average.
Okay.
That number assumes that we will never get lower interest rates, not like 6 months or 12 months or 18 months from now, but never, right? Therefore, it is our belief, and it is also the entire industry's belief, that these are the highest cap rates in this cycle. Now, they've already started to turn, right? They've already started to turn. In Q4, cap rates in the United States for multifamily dropped. They went down, which meant prices went up on a per unit basis. Now, this has only happened for 1 quarter. Q1 numbers are not in at this point in time, so I don't have them. But I'm pretty sure Q1 will also see a drop in cap rates. So imagine cap rates in the US going down for a long time. Down cap rates means higher prices. And then starting the second half of 2022, they start going upwards like this, right? They start going upwards. They go up 110 basis points. And then in Q3 of last year, they plateau. And then in Q4, they start to go downwards. And now, if you look at any CoStar report for any market in the United States, pick a market randomly, alphabetically, you will notice that CoStar is projecting that for the next 3 years, a downward, trend happens to cap rates, right? Any market in the US. We have not found a single market, we study hundreds of them, that does not have that downward curve. We found a few markets where the downward curve happens 2 months, two quarters in the future, meaning those markets are still so hard hit with supply that it's going to take them another 2 quarters to get to that point.
Right.
Phoenix is a perfect example of that. Austin is another example where the downward curve is two quarters in the future. But for the US, it's a quarter behind us. And for most market in the US, it's right now. Right now is that peak of cap rates. Now,
got to jump on the train.
There's another piece of it, and the second piece is just as important as the first. Remember that supply glut. When there's a supply glut, all these Class A properties come up. They're desperate to lease up, and they have to lease up at the maximum possible rents because otherwise they can't refinance. Because, if they don't get their rent, so Class A properties never drop their rents even when there's a supply glut. What they do is they increase concessions. So typically in a normal cycle, a Class A property when leasing up will offer 2 weeks free. So you rent for a year, you get 2 weeks for free.
Half a month. Yeah.
Half a month. Today, the average is 2 months free. That is the average across the United States.
Are you serious?
For Class A properties, 2 months free.
I did not know that.
So pick a Class A property in your market, go to their website or call them up and they'll offer you 2 months for free. Now, even if they say 6 weeks, you can tell them, I want 2 months for free, and they'll give it to you, right? Now, what this does is that essentially what this means is that every Class A property in the US right now, if you look at annual rent or effective rent, their rents are lower than Class B, right? Because on an annual basis, Class B is about 15% cheaper in rents than Class A. Well, because you've got 2 months free on the Class A, that's a 16, like 17% discount. So your Class A is a little bit cheaper than your Class B. Now, as you can imagine, what does that do to Class B rents? They don't want to drop their rents, so they start offering 1 month in concessions, right? Or 3 weeks in concessions. So now, today, the average for Class B concessions in the US is now about 3 weeks, where it was 0 in 2022. There were no concessions. So because of that, their effective rents are down. Now, because of that, Class Cs are now cheaper. So now Class Cs have two weeks of concessions. So 2 months for Class A, 3 weeks for Class B, 2 weeks for Class C. Now, because of these concessions, guess what happens? The overall income of these properties is getting hammered, even though their rents have not gone down. Their rents are the same, but their income is hammered. So all of these properties, which sell on the basis of income, are artificially underpriced because these concessions will go away. Now, how do I know that? Well, so here's my one working crystal ball, right? Everything I've said so far is predictions. I might be wrong, I might be right. But there's one part that works really well. And that crystal ball is called the multifamily permit crystal ball. It takes 2 years minimum to build a multifamily property. No one has managed to build them faster anywhere in the US. So it takes 2 years, which means that if I know the total number of multifamily permits pulled for a market or for the country in any particular quarter, I would know the supply 8 quarters from then. Yes? Because it takes 2
Right.
years to build them. And you
Exactly.
only pull permits when you're ready to go because permits are really expensive, right? A 200 unit property costs $1 million to pull the permits. So nobody is stupid enough to pull the
Holy
permits
moly,
until
yeah.
they're about to go into construction. So that is an absolute, yes, this guy's in construction. Yes, he'll have a property 2 years from now. Now, by counting the number of permits which are readily available from realpage.com, REAL page.com, I've come to the inevitable conclusion that because interest rates are so fantastically high, 12 months from now, in mid 2026, we are going to have a shortage of units. We're going to have a shortage of units
across the board
in most markets, Austin, Phoenix, not counting those two, but pretty much across the board, we will have a shortage because the absorption rate in the US of new apartments is between 400,000 and 500,000. During the glut, we delivered 600,000. So there was a glut and hence concessions. Our current run rate for those permits that people are paying millions for is only about 300,000 a year. Our demand is 450K and above. Now, every time we deliver 100,000 units less than the demand, rents don't go up by 1 or 2%. They go up by 6 or 7%. Because apartment demand is inflexible. It's inflexible. Just like gas demand, right? If the price of gas goes up by 30% tomorrow, you are still going to buy gas, correct?
Right.
Yeah, well, same thing happens for apartments.
You have no
right?
choice.
You have no choice. There's only so many apartments.
Live.
Everybody needs that many apartments. And so because of that, we know that in 26, 27, some point in 2026 or 2027, we are going to see extraordinary rent increases. That is why everything today is underpriced.
Oh my, you just made me so happy. And it's not because and I have to qualify that, when some of my ads, people are like, oh, you're a slumlord, you're buying things up and you like it when other people suffer. Guys, obviously I don't think you'd be listening to this podcast if you thought that was my mindset. My mindset is that of, I want to do the best I can as a real estate investor, and listening to this, because we really, for example, my team, we really care about our community. Like when we see something that's depreciated, like it's not doing well, we get excited because we know that those people deserve better. And yes, we can charge a little bit more, but in my experience, they're happily going to pay us the extra rent if they see us taking care of the place where they're living. And so when I hear this, it gets me excited because I'm like, I'm going to be rewarded for the hard work that we're doing. And a lot of times multifamily can be thankless for a year or two while you're renovating and leasing things up. It takes, you might get an acquisition fee on the front end if you're lucky, but for the most part, it is a thankless job for a while until you actually start seeing returns. And that really excites me because, Neil, I didn't realize how powerful cap rates were when I got into multifamily. I think I was listening to a Rod Cleef podcast and he explained, you just, divide by the cap rate, and my brain exploded. I was like, holy cow, you can make a lot of money in this stuff. And what happened was the property I bought at a 9 cap is now trading sub 7 outside of Indianapolis. And that just exploded the value. Like me and my parents, who never thought this would happen, all of a sudden became, net worth jumped by 7 figures from this one property,
Yeah.
that we bought. And to me, that was so guys, when you're hearing this, what he's describing, I'm just going to give everybody a little class here, just because we have various experience levels. When we're talking about cap rates, and Neil, feel free to correct me if I'm describing this incorrectly. Another way I like to explain it is it's kind of like a multiple. You're actually dividing by a fraction that's less than 1, but that's why it actually multiplies the value. So easy way is if it's 10%, how many 10% are 100%? There's 10 of them. So you multiply by 10 if the cap rate is 10. Now, if it's 5%, you have to multiply that NOI by 20 in order to get the value. And so as you can imagine, if you make, if you increase rents by $50 in a 50 unit, and all things staying the same, that trickles down to about $30,000 to your bottom line, which increases the value about $500,000 if it's a 6.5 cap, I think. I can't remember. I used to know these like back of the napkin math, but like all I have to do is increase the rents by $50 on a 50 unit, and all of a sudden it grows $500,000 in value. That's
right.
how crazy these
Or
numbers
more
are.
if the cap rate is lower.
Or more if the cap rate is low, right? Like it's so powerful because you don't look at multifamily like a comparable. You don't go to Zillow and be like, hey, there's a 20 unit there. There's a 20 unit there. They're on the same street, same year built, same whatever. It must be the same value. No, one could be worth $2 million. The other one could be worth $5 million because it's a business. And the more money, and so that's why a lot of our military members, Neil, they like this concept because for the first time in their life, they might actually be in control of their financial destiny, right? Like we have a military pay chart. We're like watching, okay, next year I'm going to get like a 3% bump and then this and then that. And you're like charting yourself on a spreadsheet that you don't really control, but you're like meticulously tracking. And here, I mean, Neil, I think we changed the garbage contract at an 80 unit we used to own. I think it increased the value by like at least $100,000. Just a simple garbage contract. Mm-hmm. Easy. So yeah, I'm excited because I'm under contract on one now, building a relationship with some people, and I already have 3 that just lined up. So I'm kind of growing my team, and I don't know. What do you think of? Selfishly, I'm going to ask you, what do you think of Indianapolis or outside of Indianapolis, like around it?
Each year, our most popular webinar is called Real Estate Trends. We deliver it in the last week of January because all the data from all the different sources comes in early in January, so we take a couple of weeks to massage it. I've run it 11 years in a row, and I think about 100,000 people have watched it in those 11 years, maybe a little less, 50,000 people have watched it. And the last slide of the webinar is going to make you very happy because each year at the end of the webinar, I pick an up-and-coming city and I pick a best city of the year to invest in. So, and I try to stay ahead of Milken. There's a report called Milken, which ranks cities in the US. I try to stay 1 year ahead of them. And so you can find my 10 years of picks and their picks. And I usually come in a year ahead. So my pick for the best up and coming city to invest in the US for this year is Las Vegas. And the best city in America to invest in right now is Indianapolis.
No way. Well, I'm not investing so I'm about an hour northeast is like my radius.
So what I tell people is that don't invest in Indianapolis, invest in 1/4 of Indianapolis. So I name a bunch of cities that are northeast of Indianapolis towards the direction of Fishers, Carmel, and there's Noblesville. So I sort of draw a map in that area, and I basically say so every city has something known as the path of progress. And in most cities, you'd be surprised, but almost all of the price growth is in one quadrant. And I've never figured out why one quadrant. Are you serious? Yeah, almost all price growth is in one quadrant. And so in Dallas, it's like this. So sometimes the quadrant's like this, sometimes it's like that, sometimes it's like this. In Dallas, it's the top portion, Denton, McKinney, Plano. That's the way it is. In Indianapolis, it's the northeast quadrant, which has Carmel, Noblesville, Fishers. I recommend Fishers as the best city in America to invest in inside of Indianapolis Metro. And then, if you keep going in that direction, that's where the path of progress is. So we calculate the path of progress. It's like a river of jobs. The path of progress is a river of job, and it flows like a river. It never flows in a straight line. It twists and it turns. And some parts it's fat and some parts it's thin, like a river, right? So if you can track the path of progress of the flow of jobs, you can make a huge amount of money. And I've never, ever seen a city where the path of progress was in all 4 quadrants. In fact, it's very rare for me to see it more than one quadrant. Like Houston, the path of progress, if you look at it this way, the middle part is Katy, the city of Katy, Texas, right? And the freeway that runs from downtown Houston to Katy that's the middle. And then either side of it, right? Connors, those kinds of cities are inside of that quadrant of growth. And cities, I do not know why they grow this way, but they all appear to grow this way, right? Kansas City
That's
is like this, where it's the portions below the city of Kansas centered
okay.
on Overland Park, which is the tech part of Kansas City.
That is fascinating. I mean, it almost like part of me wants to say, okay, it kind of makes sense. A, because of 80-20 principle. So there's like, well, a
Everybody
quarter's
follows
25%, but
everybody
like,
else, right? So
yeah,
what
yeah,
happens is a stream turns into a river because everyone tells
right.
everybody else, and then the people keep going in that direction, and that direction doesn't turn for a while. And when it turns, it'll turn into another city along that path, but it almost never comes back. It never doesn't circle back around.
That's truly I mean, you just made me extremely happy because like, we just had to go through that same property I'm under contract now. So I have one that I kind of like, it's my cornerstone there. It's in Anderson actually, which isn't that great of a city if you look at like, but my little sub-market part of Anderson is just perfect. It's right off of the highway, right off of Scatterfield Road. Like it's like, I don't even have to market my property in it. I'm raising rents.
And
But
that may
this
not even be normal. One of the things I want to tell people is I just named Indianapolis as the best city to invest in. In no way are Indianapolis tenants better than anybody else. Multifamily is still scratchy and problematic, and evictions are there, and people damage your property.
sure,
None of that is better in Indianapolis than in any other places. If you own a property long
sure,
enough, you'll have a gunshot. If you own a property long enough, you'll have arrests. None of those are any different. So this is not about some magical place in America where all tenants pay on time and the property is
oh,
maintained. If that's what your belief is, then maybe you should look at, something upscale at 3 cap in the San Francisco Bay Area. Everybody pays on time. But there's no way to make money there, right? Unless you want to wait for 30 years. So I think these properties in Indianapolis are just as good and just as bad as anywhere else. But the
sure.
what
I like that. Yeah.
what separates Indianapolis from others is this is a Rust Belt market that is now turning into a future Phoenix. It's turning into a future Austin. And as it moves along on a significantly higher growth path, its rents still resemble the Rust Belt. And in every city that has turned to this path over the last 30 years, there's a $500, $600, $700 jump in rents over a 6 to 7 year time frame. It's a one-time thing. You can't sustain it. But a $500-$600 rent jump over the next 6 or 7 years in the city of Indianapolis would take every project to a 4x to 10x return.
I mean, you're just making me happier and happier, so I appreciate it. But like,
You owe me 20
I actually
bucks.
experienced that even. Well, I mean, I actually experienced that even. So we got our, my very first one in 2017. The rents when we got that property were like, he must have been throwing tons of concessions because he was showing that like they were coming in at 650. We really, when we took over and I didn't know what I was doing, like we were happy to get people renting at 600. Now, $1,100 all day, every day. Like double.
And that's still low, right?
Like,
So a lot of people have to understand that most U.S. cities tend to be, on average between $900 and $1,200 in rents. Okay, so and obviously that you have to discount the West Coast and the East Coast when you're talking about that. It's the rest of the United States. And yes, there's probably places renting for 2,000, 3,000, 5,000, and 10,000. But most of America on the rental side lives in that, 900, 1,200 range. And if you track what happens to cities as they progress through that range, you fully understand how to make money in multifamily. So Indianapolis is moving through the 1,050, 1,100 portion of that range. When you start getting to 1,200, the city becomes institutional. What that means is the people who invest $100 billion start to invest in the city. So Indianapolis is now hitting the institutional, rent levels. When that happens, the cap rates go completely insane because the institutionals pay so much more than we do.
Goodness. All right. So I'm in for a ride, I guess. Now I promise I'm going to let you talk a little bit about data and AI. How are you doing on time, by the way? Like
We've got about 6 or 7 minutes, then I have to go.
Okay, no problem. Let me just ask you this. You've called data centers the new multifamily. Can you paint a picture to somebody who's not super techie? Like what is the reason behind you calling it that?
If you take the personal computer, the internet, and the smartphone, everybody knows these, everybody uses these, and multiply that by 1,000 times, you're looking at artificial intelligence. AI is the greatest invention of mankind since fire, since we invented fire about 50,000 years ago. Nothing comes close. Nothing will ever come close because AI is the uber invention. AI is the invention that creates all other inventions. Over the next 10 years, and we are very early in this phase. We're in the hype phase, right? Where people say all kinds of bullshit that's not true about AI.
Right.
So we're going to go
right.
through, the hype phase, and eventually 80-90% of the companies that start will die out, and the remaining 10% will create magnificent things. So here's the belief. I want you to imagine yourself back in 1994. Now imagine that somebody from 2022, before AI, right? ChatGPT came out November 2022. Let's say somebody traveled from one day before that. So he doesn't know anything about ChatGPT or AI, right? He just knows about smartphones, the internet, all these things that have happened. Now imagine that person in 1994 is telling you how the world is going to be in 30 years. And he describes the smartphone and he describes all the things that we do. He says every car is going to have 12 cameras, right? And you're just looking at this person saying, you're the greatest idiot of all time. I mean, and whatever you're smoking is really awesome. I'd like to smoke it too, right? But at no point would you believe that just 2 years from 1994, Amazon would be selling books on the web. And that 30 years from now, that company Amazon would basically be selling everything on the planet, right? When you start talking with that person about things like Uber, eBay, PayPal, Spotify, and basically tell them nobody is ever going to use a CD. The cars won't come with a CD player, right? Or a tape cassette player. When you describe these things and that every phone would have 10 megabit or 100 megabit internet, it sounds so astonishingly absurd. And the fact is, some of those things happen in immediately 5 years from now. We are at the beginning of that process with artificial intelligence. And the one thing that AI needs to grow, regardless of which companies succeed, which companies die, most of them will die, which is normal. If you look at 95% of internet companies, they've died. But the remaining 5%, just 5 of those companies are 1/3 of the market cap of the entire S&P 500. Just 5, right? And that's how technology works. Well, we're about to get 10,000 AI companies and 500 will survive and the remaining 9,500 will die. So I'm not asking you to invest in AI. My point is, those 500 companies, the one thing that they will fundamentally all need is truly astonishingly large compute power, right? They will need a massive increase in the total amount of computational power that the world has today. I think we're going to need about 3x in just 5 or 6 years. No one has created a plan to create that many data centers. No one knows how to create that many data centers. We don't have enough electricity. We don't have enough industrial warehousing space. We don't have enough power. I don't know the solution. They will come. People are smart. They will find solutions. I mean, Amazon is buying nuclear power plants. Microsoft has just paid for the 3 miles nuclear plant to be reopened. They paid $2 billion to reopen 3 miles. And this is the plant that has bad vibes because it blew up in
right.
I think, right? And it's now being reopened, right? So bottom line is that there is absolutely no methodology that I can find that is data-based that shows how we're going to hit the amount of compute necessary in the next 5 to 10 years without an astonishing and radical increase in the total number of data centers in the world. Not just in the US, but in the world. Where we're going to find the power and the water, I don't know. We will figure it out. But there
underwater,
will be
maybe?
Absolute explosion. Actually, people are considering data centers underwater. So data centers in space and in water have certain advantages. Water cools everything, so that reduces your electricity and cooling requirement. Space is 100 times colder than water, so you can run processors at 100 times the speed in space. So we need another 10 years before our rockets get cheap enough. So Elon Musk needs to get his act together. But I think I think those things will happen maybe 10 or 15 or 20 years from now, because we will need 1,000 or 100,000 times the amount of compute that the world has today if you go out 30 years from now. And again, you might say 100,000 times. Yes. Remember the 1994 analogy? The total amount of compute in the world today is millions of times higher than 1994.
So it's a two-part problem, it sounds like, if I'm understanding you correctly. We need the actual physical infrastructure in space. Like, you need room, you need like to put the data center somewhere.
Yes.
And then you need to build the data center and make it efficient at the temperatures and the velocity at which it's going to be like processing things. You need to solve both of those. And it's probably, not something that's going to happen overnight, but the supply and demand curve there is crazy. What you're saying is demand is like, did you say 5 or 6x outpacing anything even remotely planned as far as supply for that, right?
Sure. I just use this example of this. Ask ChatGPT, what was the average annualized growth of the smartphone from 2008 to about 2014? That was the first 6-year explosion. Then obviously it slowed down, right?
Sure.
And you'll see numbers that are truly eye-popping, right? Now AI is unquestionably more powerful than the smartphone. But all of America, starting 2007, started to adopt smartphones, and most Americans had them by 2013, right? So in 6 years, we were done, right? We were pretty much done. And everything after that has been slower growth, but still pretty quick. The same sort of thing is going to happen with AI in the corporate world. I think we have about 6 years of adoption in front of us, and then maybe another 5 or 10 years for individual adoption. There's another piece to this, which is robotics. We are finally at the point where we can make, household robots that can, obey our commands and do things. And that'll be another explosion, but I think it's 5 years behind AI. So, and robotics needs the same data centers, because remember, the robot is dumb. It's connected to the internet, and it's basically, there's a server that's processing any request you make. If you say, boil rice, that request goes to the internet, to a data center. The data center says, okay, this is exactly how it's going to boil rice. It interprets the video that's coming out of the eyes of the robot and says, I see a pot, I see the rice, I'm going to go grab the rice, I'm going to pick up the pot. So there's millions and millions of computations going on in a data center somewhere in the cloud so that the robot can boil rice.
Right. Yes, that makes sense. I want to respect your time. I've thoroughly enjoyed talking to you, Neil. Thank you so much for coming on board and providing so much value to the military investor community and to Active Duty Passive Income, our organization. Let me just end with this. What is the one, like, if somebody wants to go learn more from you, watch a webinar, download a tool or whatever it is that you have to offer with all of your amazing knowledge of data and multifamily, where should they go? What's like a singular best destination? We'll make sure it's in the show notes.
Multifamily University, which is multifamilyu.com, has 12 of our webinars every year. Mm-hmm. The 2 webinars coming up are both about the impact of AI and how to benefit in real estate from those. And those are going to be over the next 3 months. This is a free community. There is no upsell. There is no education being offered other than the free education. Just people that come in and learn. Kind of like TED.
Yeah. Well, I know I'm going to sign up for that. And I'm also going to have my team sign up for that. So that sounds awesome. Boy, thank you so much. This was a whirlwind of amazing information. Everybody, if you don't mind, do what I always ask, do what the cool kids say, go subscribe, share this so that you can impact the military community and help all of us get even better at our finances and growing our investments. Thanks again, Neil. It's been an absolute pleasure. Bye.
Bye-bye.